I analyze every market crash in history. Here's why this time is different. You know that a large majority of major stock market crashes tend to share recognizable patterns in how they unfold and recover. While the triggers can vary widely, from asset bubbles bursting to sudden economic shocks to geopolitical events or even policy surprises like what happened last year with tariffs.
Let's say China. 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 China.
The way the selling accelerates, fear peaks, and all these recoveries that play out often follow remarkably similar paths across decades and even different countries.
84, 1901, 07, 29, 1937, 1974, 1987. Jesus, didn't that fucker fuck me up good? 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves, do we?
I've studied every single crash to show that these events are not random. They've been around since the beginning of time and is a built-in feature of market cycles driven by human psychology and liquidity dynamics. The good news, understanding these recurring patterns can help investors like you and I sidestep the most common mistakes, like panic selling near the bottoms or jumping in too early during fake rallies.
Il solde. Bumpy.
And instead position to benefit from the inevitable rebound. They always say buy the dip, right? But they never tell you when to buy the dip. Let's dive into the key patterns that emerge consistently from the data. First, recovery shapes. Crashes don't all recover the same way. And there are 4 primary shapes you see repeatedly. The V-shaped recovery is the one everyone loves and hopes for. This is a steep plunge followed by a rapid, powerful bounce back to new highs, often within months. So it's a very fast one, and it feels great if you're positioned right because the money comes in fast. But the reality from historical data is that true V-shapes only happen in about 18% of cases, less than 1 in 5 crashes. They are the exception, not the rule. Far more common is the U-shaped recovery. This is where the market drops sharply, then enters a prolonged period of grinding sideways, often 6 to 18 months or longer, and then there's a lot of volatility, false starts during this region, before finally trending higher after some uncertainty. This extended bottom phase tests a lot of patience, normally it shakes out weak hands. That's how it works. Then there's the W shape or double dip, an initial sharp drop followed by a convincing rally that draws buys back in, only for the market to plunge back, sometimes even lower, trapping optimists, but then eventually it goes back up. So we can sometimes look at this as a double bottom or a swing failure bottom. Alright. Finally, we have the more elusive and rare L shape. You gotta take the L's.
Firmly grasp it!
Right? This is where the crash happens, but the market stays depressed for years, sometimes decades, with little meaningful recovery. A very, very good example of this is Japan's Nikkei, because after the 1989 peak, it took so long to recover this year. This only shows up in around 7% of cases. Why does this matter? Because most retail investors default to expecting a V-shaped recovery. They want a bounce that's happening quick, they say buy the dip, but when it doesn't happen, which is 82% of the time, they'll get whipsawed, buying too soon, or sell in despair near the lows. Look at recent volatility earlier this year around policy shifts, right? We had an initial close to 20% sell-off after Trump's inauguration and when tariffs first came about. This felt catastrophic at the time, right? But look at it, the stock market right now, especially the US one. The US tends to follow a V-shape the most often. That's also because they have backdoor funding, they do a lot of quantitative easing. These backstops, when they come in, it's when we get those V-shaped recoveries. A lot of the other markets, when you look at Chinese markets, Japanese markets, even bonds, they operate more like a U-shape, right? So without these changes and money printing, the stock market will also likely look like a U-shaped grind. What does this tell us? Data across decades show a clear sweet spot. The strongest risk-adjusted long-term returns typically come from beginning to deploy capital when broad indexes are down 20 to 35% from their peaks, not waiting for deeper capitulation. As always, if you want to learn more about financial markets or economics, do check out our website for free newsletter and academic courses. Remember to like, share, and subscribe, and I'll see you guys next time. Bye.